Hello, welcome you all who is watching this video. So today we are going to discuss about the working capital management, and there is a different sources of the working capitals. Means is that the sources, as you know, the working capital previously we have discussed in the previous class. For doing the activities in the organizations in the daily routines, they are required the money. Means the short term in a financial year, we are going to calculate how much money is required to fulfill all the activities of the organizations. So the smoothly running of the organization. So another is the sources of the working capital. That is, if the organization is not having the maximum resources, which kind of the resources? The financial resources for managing the working capital. So the managing working capital resources. What are the various sources for generating the funds for fulfilling and making the effectiveness of the working capitals, and the all activities going to be performed smoothly. So we will discuss. So part one, that is the working capitals. So in this chapter we are going to cover definition of the working capitals. Another, why working capital is required. Why we are going to calculate about the working capitals. Objectives and aspects of the working capitals. What are the objectives and various aspects is going to be working capitals. Purpose. What are the various purpose for and needs of calculating the working capitals. Component of working capitals. What are the various components we are going to use for the calculating working capitals? Concepts of the working capitals. So these are the various things we are going to cover. First, we are going to discuss about the introduction part. That is, the working capital play the crucial role in the businesses as the role offered in the human bodies. Simply, we can say the working capital is the heart of the organization, because the activity is going to be performed first, going to perform the production cycle, purchasing the raw material, then we will make it the progress, then we will make the finished product. After getting the finished product, we are going to sell that particular product. So from the phase one, starting to selling that particular product and earning the money, earning the fund from the selling, for the cycles, that cycle is called the activities, that called the working capitals. So for managing that activity, so the all activity from starting to end is going to be performed well and effectively. That's the basic means of the working capitals. So there is a here is the definitions of the working capitals. Working capitals refers to fund required, means which of the fund it is going to be required to be invested in business for a short period, usually up to 1 year. Means is that the simple is the means of the working capitals is refers to the funds which is going to be required to invest the funds for fulfilling the activities within the month. It is going to basically used by the short periods, means 1 year or less than 1 year. It is also known short-term capitals or calculating capitals. Another words for the working capitals we call the short-term capitals. Means because the working capital which we are going to calculate for the period for the short terms, because it is going to require for the short terms capitals or the calculating capital also called. So we are called to the working capital as a short term capitals and the calculating capitals. Working capital is the amount of funds necessary to cover the cost of operating the enterprise. Means it is the working capital is the fund for what? The necessary fund is going to be necessary for the working capital because it is cover the cost of operating the enterprise. Means the whole organization process. It is going to cover for what? The whole organization process which is going to daily routines. Next is why working capitals. So the firm has to be maintain cash balance to pay bills as they come due. Simple is. So basically it is required the working capital because the firm is going to maintain the cash balance because in the daily routines they are going to perform the particular activities. So maintaining that particular activity, it is going to maintain the cash because he is going to provide the bills in the daily routines. He is purchasing something, purchasing the raw material and daily routines. In additional, the company must invest in investors to fill customer order proper. Simple. Means properly he is going to provide it to fulfill the customer orders. And finally, company invested in accounts receivable to extend the credit to customers. So that's why they are going to be required for the working capital. Another is the objective of the working capitals. What are the basic objectives? To optimize the investments in the current assets. Means which of the current assets? Current assets which is easily, very easily we are going to convert in the cash. That's called the current assets. So the working capital means is simply we will discuss in the next, that is the current assets minus current liabilities is the basic things is there. To see the company assets is the current liabilities obligations. Management manage the current assets to see that the return on current assets is more than cost of the capital. Means is that which of the fund he is going to invest it in any projects. Organization want to getting his return. What is the return he is earning from his investment, which is going to be invested in previously, and the cost of the as is the more than the cost of the capital. So another the proper balance between the current assets and the current liabilities. So the objective of the working capital that is to making the balance between what the current assets and current liabilities. Means these things we are going to convert into cash very easily, and another that we are going to pay in the short of the period. So making the balance between current assets and the current liability means short-term earning, short-term fund we are generating, and short-term funds we are paying to someone, that making the balance. These are the examples. Statement of the working capital is the only for the examples is the 1st January 20. That is current. One side is the assets is there. That is called the current assets, and the current liabilities is there. Means the cash which is having the $1,000. Receivables means in the short term we are going to receive from our debtors which we have provided the cash. So $4,000 we are earning from them. So total current assets is the $5,000. Another, the fixed assets. Which of the fixed assets which we can like the machinery, and then long term we can convert into the cash. That is the land. Dollar is the 15,000. Buildings 45,000. Equipment 6,000. So the total assets in this figure it is going to show the total assets is 71,000. So the asset size is there. Another is the liabilities, that is the current payables which we are going to pay the $12,000. About the 90 days notice means we are going to pay within the 90 days, means the 3 months is the $1,000. Bad debts reserve means which of the money is going to be bad debts is the $2,000. So total current liabilities is 3,200. On the long terms, the mortgage that $22,000. Another is the equities like the $45,800. So total liabilities and equities 71,000. So that is the basic format for preparing the current the working capitals. Means one side the current assets and another is the current liabilities. Sometimes the working capital is goes to in the minus, because when the current liability is going to exceed from the current assets. So the working capital consists of the difference between the total current assets and the total current liabilities. Like 5,000 is the total current assets and the total current liabilities is 3,200. So the total working capital we can get in this example, that is the $1,800. So the bad debt reserve is an artificial number selected by the management based on the prior experience. Regarding the amount of accounts receivable that will not be collected during the current period or perhaps at all. So that is the basic things is for calculating the working capitals. I hope you will understand. So for watching this example. Next is we are going to discuss about the aspects, which of the aspects of the working capital. There are many aspects of the working capitals which makes it important functions of the financial management. Simple is, first one is the time, another is the investment, third is the credibility, another is the growth. So there are the basic aspects for the working capitals. So we are going to calculate that: time, investment, credibilities, and growth. Next is the purpose of the working capital's main important aspects. Why we are going to studies, why we are going to calculate what are the main purpose for calculating the working capital to hold the stock, the raw material for such a period. So the purpose of the working capital is the first one is that to hold the stock means as we know every organization, every company is going to produce something for fulfilling the needs, wants and demand for the societies. So what is going to be producing to the societies that is required the raw materials because in the first period for manufacturing of anything we are going to purchase the raw material. So to purchase the raw material they are required the working capital means how much of the quantities of the raw material we have required and how much money we will invest it to purchase the raw material. So this is the basic purpose for the working capital. Another is to hold the stock of work in progress for process periods. Means is that in the second thing is whatever we have produced and how much time it will take to convert into cash that we have to produce. Means suppose we are going to manufacture any notebooks. If the notebook we have manufactured, then we are going to calculate how many days the notebook is going to convert into the cash. Means first the notebook is going to be marketed, then we will sell out that, then the sort of period we are getting the cash from that particular notebook. May how many times get in the process for that converting the cash means 5 days, 10 days. So the 10 days of converting the cash, so the how the 10 days the operating operations for the particular product is going on because they are required the money for the 10 days. So there is to holding the stock for the particular product for the 10 days. That is the basic requirement of the working capitals. Another to hold the stock of finished good for such a period means sometimes that we are going to manufacture few of the part is going to suddenly the finished for making the stock for the 1 month, 2 month of the stock of the raw material is also required the money, also required the working capital. So that is the another aspect to another purpose for making the working capitals. To grant credit to customers means as per the calculating of the working capital, suppose we are the providing our product to the customers for on credit, then we are giving such time to the customer to pay that particular amount for the particular product like 10 days, 20 days to identify those figure how much days he will take, then are the most purpose for the working capitals. Another to hold the cash balance to meet the expenses means which of the expenses we are going to expend means that expenses which we are going to expense in the short term of the period like 1 month, 2 month, 1 year. So to expend to fulfilling the expenses we are required for the working capital. So all those purposes we are going to cover, we are going to understand about the working capitals. Need of the working capitals. There are the two things is there. Operating cycles means operating cycles. Previously, I have given the examples means from the purchasing raw materials. First, make the process means going to create that product into the finished part means the getting the final product. Suppose we are making the notebook, then we have to purchase the which material is going to be required for preparing the notebook. Like the papers. First we have to make the papers. Papers is the raw material. Then we will make the process according to the size of the papers that the notebook is going to be covered. So prepare in the one slice for that particular paper and fit them and prepare that particular finished product means notebook is the ready. So from purchasing and the notebook is ready, then we are going to sell out in the market. So money is also going to cover. So for the starting point means to purchasing the raw material to converting the gas, that is the operating cycles. Operating cycle in a trading firm is the length of the time requirement means how much time will take to prepare this process, that is the working capital's needs. Operating cycle in a manufacturing firm is the length of time required means in the examples you are going to see cash. We are first getting the cash in this diagram. You are going to show inventories of raw materials. We can say inventories of VAP means making the process for that. Inventory of FGs means the finished goods. We are called, and then we are going to receive the cash. So that is the operating cycle. That is the distant phase of the operating cycle. Means from the starting point, first for getting the cash in hand, purchasing the raw material, process that particular product. After getting the finished product, then we will sell out that particular product, and when we are going to sell, then is the first phase is starting for the cash in hand. So that is the another is the gross operating cycles. So that is the gross operating cycle. That is the first phase to the raw materials. Then we will prepare for the finished product. We will convert it. Then providing that in the storage means keep the storage. Then we will sell the particular products on the creditors. Then we will collecting the cash from which which are the debtors means who was purchased the product from us on the credit. So that is the gross operating cycles. Means for the standard operating cycles, that is the product created, purchase the raw material, process, finished good and sale and directly converted into cash. But the gross operating cycles, raw material, finished product, getting the final product, keep in the storage. After storage, we are going to sell out that on the data, on the credit, providing the notice 90 days, 100 days, you are giving us the amount for that particular product. Then after the time period is going to be reduced, then going to be covered, then we will collecting the money from our debtors. So that is the gross operating cycles in this diagram. So you are going to see net operating cycles. You are going to see RSPs, WIP, means first we are going to cover raw material, finished goods, and credit collections periods, providing on the creditors, and the NOCs, net operating cycle, simply. Next is how to calculate component of operating cycles. That is, there is some of the formulas which I am going to show you. Average raw material storage periods in a days. So there is the formula, average stock of any particular raw materials divided by average cost of the raw material consumptions per day. Means average stock, how much stocks we have, and going to be divided by the average cost of the consumptions that particular things per day, means the one day. Another average WIP holding periods in a day, that is the average stock of WIP, means finished products, divided average cost of VIP per day. So that is the another formula. Next is the average FG storage period in a day. We are going to calculate in these things, that is the average stock of FG divided by average cost of goods produced per day. Another average debtors collections periods in a day, means which we are going to provide it on the creditor. We are going to calculate to help of these formulas, that is the average trade debtors, means which of the average of the trade debtors every day, how many of the debtors trade is going on the debtors, divided by the average cost of credit sales per day, average creditors payment periods, means how many days we are getting that particular payment, that is the formula is there. Average trade creditors divided by average credit purchase per day, means average creditors divided by the average credit purchase, how many of the raw material, how much of the raw material we are going to purchase on the credit per day. Another, the average time lag in the payment of the expenses in a day. Then we are going to calculate with the formula, average creditors of 4 expenses divided by average expenses per day. So these are the formulas for the operating cycles. Now, how to calculate number of the operating cycles in a year? The number of the operating cycle in a year may be calculated as the follows. That is the number of operating cycles in a year, means how many of the operating cycles in a year, that we are going to calculate. Number of days in a year, means how many days in a year, like 365 days, and net operating cycle in a day, means net operating cycles which is going to be operating in a day, particular net operating cycles. So we are getting the number of operating cycle in a year. These are the another examples. Are invested inventory consumed during the year, that is a 60,000. Average stock of the R, that is the 10,000. 1 lakh something. Factory cost of the good product produce means 1 crore 5 lakh something. Average stock of WIP, that is the 4 lakh 37 500. Office cost of the good produce is the 1 crore 40 lakh. Average stock of FG, that is the 9,50 9 lakh 50 15,000, sorry. Average trade debtors, that is the 11 1 lakh 12,500. Cost of the credit sales, average trade creditors expenses for the year 30 lakh. Average creditor for the expenses, that is the 5 lakhs. So these are the basic things is going to be there. The expenses for the operating cycles, number of days in a year, like the assumes 360 days, because few 4 days or 5 days is going to be closed by the cycles or not. It will depend on the various levels of the organizations. So here we are going to calculate about the 360 days. So these are the basic things of the years. For the above following informations of the company, we are going to calculate the gross operating cycles, net operating cycles, number of operating cycle in years, 3 parameters, which we are going to calculate for that informations. So that are the concept of the working capitals. As we know, the working capital is the two types on the basis of the concepts, on the basis of the time. Means first is the basis on the concept we are going to require for the working capitals. Another is the basis on the times. Like the basis on the time, that is the permanent working capitals and the temporary working capital. So the permanent working capital, that is the fixed permanent. Suppose for the manufacturing of that particular product, like the 5 labor is required. So that is the 5 labor is required. That is the permanent working capitals. In a year, we are going to produce the 10 unit for that particular product. So the 10 units is the fixed for the working capitals for the per products. In the temporary working capital, that is the, if suppose we are going to purchase of the anything according to the time, like the seasonable or unseasonable, we can say. Suppose we are going to prepare the sugar, then the raw material of making the sugar, that is the sugar cane. So the sugar cane we can purchase on the seasonable basis, means on the time. So that is the things. So the gross working capital is going to be or created. Net working capital on the basis on the concepts. So the net working capital is the fixed. It is not going to be variables. So on the basis of the concepts and the values, gross working capitals, it refers to the firm investment in the current assets. Simply, sales that includes like the stock of the raw materials, WIP, FGs, etc. In the for the equations, gross working capital can be sourced. Gross working capitals is equal to cash which we are having plus inventories. Inventory for what? Raw materials. How much of the raw material we are having? Work in progress. How much of the work we are under process or we have progress? Work in progress is there, and the finished goods also is going to be covered in the gross working capitals. Means the product, how much of the product we are going to finish for that. So that is the finished goods is also going to be covered in the gross working capitals plus short term marketable securities. Means for the short term, the people who is going to be put the market security which he is going to pay to us, like the 3 months, 2 months, 13 days, 20 days, and the other current assets is going to be included, then the all those parameters is going to be included, that we are calculate, then we are getting the gross working capital. So here you are going to show in this diagram the net working capitals. It refers to difference between the current assets and the current liabilities, net working capital. Then we are going to minus of the current assets minus current liability. We are going to differentiate, that is we are going to get the net working capitals. So CL includes trade creditors, bill payables, expenses, etc. So net working capital is a qualitative concept. Which concept? Qualitative concept, which include liquidities, positioning of the funds, part of the current assets which should be financed with the long-term funds is also in the form of the equation. Net working capital has been shown below, but our net working capital, how we are going to calculate with the, we are going to use the formulas, that is the gross working capital or the current assets is going to be less the current liabilities. When we are going to less the current liabilities minus current assets, we are going to get the net working capitals. Here I am going to give the examples. A company buy the stock of the raw material for cash. Means any of the company is going to purchase the raw material on the cash. It impulse that the company is financing the raw material stock from its internal sources. Suppose the company gets a 2 months credit for the same purchase, it impulse the stock is financed by the creditors. Here is the difference between the gross working capital and net working capitals. So the gross working capital is the quantitative in the natures and the net working capital is the qualitative in the natures. Another, the gross working capital, it indicates the total sum of the current assets. Net working capital, it expressed as the current assets including the current liabilities. Gross working capital, it is suitable for the companies and the organizations, whereas the net working capital, it is suitable for the sole traders and the partnership firms, means the small levels. Gross working capital, it is the concept very popular in the financial management. Net working capital is the concept of very popular in the accounting style. Gross working capital, it cannot reversal the true financial positions of the organizations. Net working capital is very useful to find out through the financial positions of the organizations. means the small level of the companies. On the basis on the time, that is the permanent working capitals, permanent or we can say the fixed working capital, another is the temporary working capitals. So the permanent working capitals, that is the regular working capitals, and the reserve working capitals, means we are getting some of the amount for the reserves for the risk and uncertainties, that is the fixed working capitals. Another temporary, that is the temporary working capital, we call the seasonable working capital and the special working capital. So these are the basis on the time of the working capitals. Next, we are going to discuss about the sources of the working capitals. What are the various sources from the working capital? That is the first thing is the loan from the commercial banks. So it is a very easy way to generating the working capitals from the organizations. There are so many banks is going to provide the loans from the business needs is going to be fulfilled. So the small scale enterprises can raise the loan from the commercial bank with or without securities. It depends on the bank policies. This method of the financing does not require any legal formalities except that of creating a mortgage on the assets. Loan can be paid up lump sum on in the parts. The short-term loan can also be obtained from the banks on the personal securities of the directors of the country. So these are the basic things, very easy methods to generating the loan from the commercial banks for fulfilling the working capitals. Another is the public deposit. Often means companies find it easy and convenient to raise the short-term funds. So by investing, shareholders, employee and the general public to deposit their saving with the company. It is simply method of raising fund from the public for which the company has only to advertise and inform the public. That is authored by the Companies Act in 1956 to expect the public deposits, means is a very easy method. You can deposit from the getting from the deposit for the publics. You can issue the shares and so many other criteria. Trade creditors means just as the company sell goods on the credit, you should means just which we are going to purchase the raw materials. You can purchase the raw material from the creditor from your vendors. That is the basic concept. So that's they also buy the raw material components and other goods on the credit from their suppliers. Those the outstanding amount payable to the suppliers. Example, the trade creditors or the credit purchase are the regulated as the sources of the finance. Generally, supplier grant the credit to their clients for a period of 3 to 6 months. Next is the factoring. Factoring is the financial services designed to help firms in the managing their book debts and the receivables. In a better manner, the books debit and receivable are assigned to a bank called a factor and cash is released in advance from the banks. For rendering these the services, the fee of the commission charges is usually a percentage of the value of the book debit and receipt the factored. So that is the basic things for the factoring. Next is the discounts, discounting and bill of the exchange. The bills is going to be exchanged between the when goods are. It is
This sir.
systems is that when goods are sold on credits, bill of exchange are generally drawn for the acceptance by the buyers of the goods The bills are generally drawn for the period of the 3 to 6 months. In practice, the writer of the bills instead of the holding the bill till the date of maturities prefers the discount them with the commercial bank on payment of a charge known as discounts. Another, bank overdraft and the cash credit. Overdraft is the facilities extended by the banks to their current account holders for a short period, generally a week. A current account holder is allowed to withdraw from its current deposit account up to the certain limits over the balance with the banks. The interest is charged only on the amount accountly overdrawn. The overdraft facility is also granted against the securities advance from the customers. The another options from the organizations can get the advance from the customers. One way of the raising the fund of the short-term requirement is to demand for advance from the one's own customers. Examples of the advance from the customers are advance paid at the time of booking a car, a telephone connection, a flat, etc. This has become the increasingly popular sources of the short-term financings among the small business enterprises, mainly due to the two reasons: actual account. Generally, there is a certain amount of time gap between the incomes and earned and is actually received of the expenditure become due and is the actually paid salaries, wages and the taxes is also going to be included. For an example, become due to the end of the month but are usually paid in the first week of the next month. Those the outstanding salaries and the wages and experience as expenses for a week help the enterprises in meeting their working capital requirement. This source of rising fund does not involve any cost. So these are the basic things for generating the funds for the working capitals, sources of the working capitals. Now I'm going to provide a few question and answer. You can give the answer. You can analyze yourself how much you have learned from watching this video. The major current assets are another. The basic current liabilities are another. There are the two components of the working capital: gross and what? Give the right answers. Working capital refers the firm's investments in the current assets. Another, working capital refers to the difference between the current assets and the current liabilities. Blank space fill. A net working capital will arise when the current assets exceed current liabilities. Another, a blank space net working capital occurs when the current liabilities are in excess of the current assets. Another questions, investment in current assets should be another, on the basis of blank space working capital is classified as the gross working capital and net working capital. Give the right answers. Another, on the basis of blank space working capital may be classified as two things, that is the permanent of the fixed working capital, second temporary of variable working capitals. Which of the concepts? Time, features, work and the concept. So I hope give the right answers. You can analyze yourself how much you have learned from watching these videos. I hope you have learned a lot from watching this video. Thank you for watching the video. Thank you very much.